Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Welcome to The Bigger Picture. I'm Dan Koh. Now, the global manufacturing is showing signs of life, but the recovery remains uneven. Here in Singapore, factories are finding their footing again, even as tariffs and weaker demand cloud the outlook. And with the Fed minutes due later this week, markets will be watching closely as to how policymakers are navigating slow growth and a U.S. data blackout. Well, joining me this morning to break down all the latest economic data, we've got Pan Jingyi, the Economics Associate Director at S&P Global Market Intelligence. Good morning, Jingyi. How are you doing today?
Well, good morning, Dan, and I hope everyone's having a great start after the exciting weekend we had.
Yes, pretty sure that everyone's slowly recovering from that weekend. A blast indeed that most of us would have had. But yes, to start off, let's zoom in onto Singapore's factory sector, where we're seeing the official manufacturing PMI for September inching up to 50.1. That's from 50 back in August, and also marks the strongest reading in 6 months. After all, a PMI above 50 indicates expansion, so while it's subtle, it is certainly positive. Now, notably, the electronics sector, which makes up about 40%, posted a stronger 50.7, up from 50.4 in August. So it does suggest that electronics is still carrying much of the good side momentum. So how are you reading this latest PMI uptick? Is this a sign of recovery in Singapore's manufacturing, or is it more of a temporary reprieve?
Well, thank you, Dan. So it's a great question because this is September data that we're looking at, and this is already with the tariffs having fully set in since the early August implementation of the tariffs. And I think this itself has given us a bit of relief that it's pretty positive, as you pointed out, with the SIPMM manufacturing PMI for Singapore that's reverted back above 50, but also with the S&P Global Singapore PMI, which we track the entire economy, that's actually risen to the sharpest in actually 1 year. So altogether, it's telling us a positive sign in terms of the recovery. But if we look around the region, it's been pretty uneven, I would say. You will see some of those who are performing well, including the likes of China and also South Korea, but the likes of Taiwan and others, those are seeing the impact of tariffs in a strong manner for Singapore. What we do see, however, is that some of this boom, at least for the electronic sector, those seems to be still coming on from what could be eventually fading front-loading activity still. So that's actually given the manufacturing sector, I think, still a small boost in the September reading. I think it is a positive sign, showing resilience at the end of the third quarter, but I think we're still going to be a little bit cautious as to what this itself is going to mean. For what it's worth, however, we, in the whole economy PMI we tracked with the S&P Global data, manufacturing have been among the best, but the best is actually the finance and insurance sector. So perhaps it's showing us that, as the tariffs itself are coming through, that has been set in August, and some of the sector ones been announced, people are perhaps regaining a bit more confidence in terms of their investments into the end of the year. Hopefully that's going to help to offset some of the slowdown in the manufacturing sector, but we'll definitely see, how eventually that pans out in the last quarter of the year.
All right, that's a good breakdown of what to expect within the sectors. Now, Jingyi, do you see signs of resilience in other sub-segments like perhaps, chemicals or machinery, or is this just a narrow tech recovery? And what's your take on the fourth quarter, especially amid the rising risks from, new round of U.S. tariffs?
Well, then, so we do have a global electronics PMI that we track at S&P Global Market Intelligence. And I think it's also been interesting that you asked this because when we look at the data, you are getting the likes of computing and communications, those that are very much perhaps still tied to the AI theme as well. Those are actually above 50 and expanding. And then on the other hand, you have industrial equipment and some of the consumer as well. Those are coming down to see a bit of a slowdown in the momentum. So I would say that that's not really a very even one, even within the electronic segment altogether. But outside of the electronic segment, I think, we are also seeing the picture really not perhaps, helping a lot of the other manufacturing sectors, because what's been helping to lead growth in the September month itself is the likes of technology and finance, pretty much similar to what we have in Singapore. But if you look at the global scale, the likes of industrials and basic materials, those are under quite a bit of pressure, and that's suggesting that perhaps, this is still a lot of front-loading activity that is going on with people picking up this electronics ahead of more uncertainty that could come around with the tariffs. But on the other hand, just on the manufacturing side, I think the slowdown in the basic material is a telltale sign that we might be seeing a more subdued fourth quarter. So I think from that perspective into the final quarter, a lot of the themes might be rolling, because we have had more of this broad-based improvement in the economic situation so far, even the second quarter and fading to third quarter. But the fourth quarter, I think we might have to be a bit more selective as to which sector to really look at then.
Fantastic. Thanks for breaking all of that down for us, Jingyi. And just to note, S&P Global Manufacturing PMI came in at about 50.8 in September. That's a down touch from 50.9 in August. And it also does show that it is a fairly lukewarm recovery that we're seeing here. So it's a good mixed bag that we're seeing. I guess, mixed performance across regions, strong gains in India, Thailand, and Vietnam, but steep declines in Taiwan and Russia and Brazil might also pose some form of concern to the market. So how much of this divergence comes down to the U.S. tariffs, would you say, Jingyi?
Well, then I would say that the U.S. tariffs perhaps is the key driving factor over here. To a large extent, I think, again, taking a look at what's happening in Asia Pacific, we do see some of the regions, as I mentioned, mainland China and the likes of South Korea. Those are perhaps benefiting a little bit from more relief that, the tariffs was not perhaps as high as possible. Of course, China, there's still uncertainty there, but we did get some of these talks going on. But at the same time, the other ones, including, we've seen the likes of Taiwan, some of the ASEAN countries, and also to the likes of Australia, those are comments coming through from the companies are telling us that the tariffs have directly affected them, but also indirectly as well, in dampening sentiment across the region. And that is actually affecting consumer and also, business-to-business demand in September. So I think this is going to be a bit more prominent as we go into the end of the year, especially, as the front-loading effect continue to actually fade. Of course, at the same time, it's going to be one that's also hinging on what the Fed may do, because interest rate is going to play a big part here then.
For sure. And interest rates is exactly what we're turning to next after, the breakdown on the latest manufacturing data. So let's talk about the Fed and what its upcoming minutes could signal for rates and growth. And if you remember, the Fed cut rates by 25 basis points just recently, back in September, bringing the federal funds target range to about 4 to 4.25%, the first cut since September of last year. So, Jingyi, what would count as a dovish versus hawkish cues in the Fed minutes? What kind of language or narrative shifts should we be looking out for?
Definitely, then. So in terms of what the Fed are concerned, I think we are quite cognizant as well that it's really the balance, the dual mandate. At one point, we do see that, especially in the latest meeting, that they have shifted a lot more of this weight into their concerns over the labor market, which, as we have seen, growth has been a bit more subdued in terms of jobs growth. So that has actually triggered them to actually cut for the first time in the last meeting. And I think the market has really bite onto this because they're expecting more of this to come through. So if that comes across as a prominent language, I think that will be something to really be aware, and that perhaps, give more weight to more of these cuts through the rest of this year and to the start of next year as well. But at the same time, I think what is the elephant in the room is the inflation picture. Inflation in the US hasn't risen perhaps as much as the expectation with tariffs that it will be. But at the same time, I think they're not discounting that inflation could still rise further. So I think how they actually balance the language between these two is going to matter, because we did see a bit of change from the rhetoric in the post-meeting, in the Fed post-meeting, but whether that actually takes grip as well in the minutes is something that we look at. Of course, the picture as well has been marred by the fact that there is this shutdown, and we did not get the jobs report on Friday. So I think there is a bit of high uncertainty coming through.
All right, Jingyi, just very quickly before we wrap up today's conversation, what's your message to investors navigating the mix of tariffs, rate cuts, and of course, soft data as we step into the fourth quarter?
Certainly then. So I think the big picture here is that we still have tariffs. It's the driving factor for what we've talked about, supply chains, the outlook situation. And some of the bigger deals haven't really come through, including the likes of US and also China in terms of their trade picture. So that's something just to take note into the end of the year. But of course, turning the topic back to the economic situation, inflation, whether that changes. Hopefully, we're going to get the shutdown completed, reopening before the CPI report this month, and that's going to be an important key piece of information for what the Fed will do. But generally, that picture is going to be a key driving force of interest rate and thereby our, growth picture and investment picture. Then.
For sure. Thank you so much once again for breaking it all down for us and joining us this morning, Pan Jingyi.
Thank you very much.
All right, and we've been speaking to Pan Jingyi, the Economics Associate Director at S&P Global Market Intelligence. Keep it right here with us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.
Money FM 89.3